Good evening, everyone. A very warm welcome all for Embassy REIT's second quarter FY2024 earnings conference call. Currently, all participants are in a listen-only mode. Our speakers will address your questions at the end of the presentation during the question and answer session. As a reminder, this conference call is being recorded. I would now like to introduce your host for today's conference, Ms. Sakshi Garg, Investor Relations Manager for Embassy REIT. Ma'am, you may begin.
Thank you. Welcome to the Q2 FY2024 earnings call for Embassy REIT. Embassy REIT released its financial results for the quarter and half-year ended September 30, 2023, a short back. As is our standard practice, we have placed our financial statements, earnings presentation discussing our performance, and a supplemental financial and operating data book in the investors section of our website at www.embassyofficeparks.com. As always, we would like to inform you that management may make certain comments on this call that contain forward-looking statements. Please be advised that the REIT's actual results from these statements. Embassy does not guarantee these statements or results and is not obliged to update them at any time. Specifically, any financial guidance and formal information that we provide on this call are management estimates based on certain assumptions that have not been subjected to any audit, review, or examination procedures. Caution not to place undue reliance on such information, and there can be no assurance that we will be able to proceed. Joining me today are Aravind Maiya, our CEO, Agarwal, our CFO, and Ritwik Bhattacharjee, our CIO. We'll start off with brief remarks on our business and financial performance and then open the floor to questions. Over to you, Aravind.
Thank you, Sakshi. Good evening, and thank you all for joining us today to discuss our Q2 results. Start with key highlights for the quarter. We achieved our highest ever quarterly leasing of 2 million square feet, delivered a new office tower of 1 million square feet in Bangalore, and announced distributions of 5.4 per unit. Although our portfolio occupancy saw a temporary due to an anticipated large IT services exit, we have a strong pipeline to backfill the space. We remain on track with our FY24 financial guidance, and taking into account a large early renewal of space at our Embassy Golf Links Park, we are raising our leasing guidance 6 million square feet to 6.5 million square feet for the full year. To start on the macro front, global companies continue to flock to India on the back of our India talent available at scale. In the first half of calendar year 23, 21 new global capital centers were set up in India, including new entrants. Considering this buoyancy in demand for premium Indian office spaces, independent property consultants have raised current year forecasts for office absorption. We're also seeing an increase in the active request for proposals in the market, which have gone up from 8 million square feet as of July 23, 20 million square feet today. Around 6% of these open space requirements are for Bangalore, a core market. Additionally, return to office continues to pick up pace in India, with multiple large employers mandating employees to work out of offices. With this backdrop, let me now update you on our Q2 leasing performance. We leased a record 2 million square feet across 25 deals and expanded our occupier base to 240. Included 1.2 million square feet of new leases and 0.7 million square feet of renewals at 6% rent reversions. Renewals included a 0.6 million square feet of lease expiry due in FY25, for which renewal terms were agreed with IBM over a year in advance. Further, for our existing tenant ANZ, exercised a third option for an additional 133,000 square feet in the under development Block C in Bangalore, and with this, the building is now fully pre-leased. Continuing the trend from the last quarters, the leasing demand was primarily driven by global capitals, contributing to over 70% of our leasing. In terms of sectors, technology, BFSI, and healthcare firms led the demand. Interestingly, 7 deals over 100,000 square feet, including 1 deal over 500,000 square feet, were signed by us this quarter. It clearly indicates that global corporates are getting increasingly confident of their business and headcount growth in India, and hence accelerating their medium-term real estate planning. We noted leasing traction across our assets and signed deals for 9 of our properties. With this, 50% of our properties are now back to 9% occupancy levels, and our Embassy 247 Park in Mumbai, 100% occupied. In terms of markets, Bangalore and Mumbai led the demand and contributed over 90% of the leasing this quarter. Two cities which represent our largest markets and over 85% of the portfolio value are near or above 90% occupancy levels now. Overall, our office portfolio is at 80% occupancy by area and 80% by value. On a same-store basis, occupancy stood at 7%, which excludes the recently delivered MC Block A, Hudson and Ganges Block Pune, and the recently vacated F2 building in Embassy Manyata, which is currently under refurbishment. In terms of exits, I want to highlight that of the 2.3 million square feet exits in the last 6 months, we've already backfilled 1 million square feet of space at market rents. Balance 1.3 million square feet was primarily exited by 2 large Indian IT services players at Embassy Manyata and Galaxy Business Parks. We have a strong pipeline for both these spaces and are confident of backfilling at least 50% of this space at the end of the financial year and realizing over 50% market on the same. Of 2.2 million square feet current vacancy, around 50% concentrated in Pune and Noida, both of which are significantly lower rental market for us. The vacancies in these 2 cities will take some time, but it is important to highlight that even post stabilization, it will translate to only approximately 5% of our current NOI. So at the halfway mark for this year, we have already leased 3.1 million square feet and have a record leasing pipeline of 2.5 million square feet, which includes 1.3 million square feet against existing space and 1.2 million square feet of commitments in our development portfolio. Considering the 0.6 million square feet of early renewals signed this quarter, we are raising our FY24 leasing guidance from 6 million square feet to 6.5 million square feet. Comprises 4 million square feet of new leasing, including the new deliveries planned this year, 1.3 million square feet of commitments, and the revised 1.2 million square feet of renewals. Overall, we expect that by the end of the financial year, our full portfolio occupancy will end at around 85%. This will include the impact of 0.1 million square feet of buildings being delivered this year, including 0.7 million square feet cover in Noida, where the leasing demand is muted. On a same-store basis, we expect occupancy to end at around 8% levels by March 24. On the SEZ front, we successfully denotified 0.4 million square feet building in Embassy Manyata. We've also applied for denotification for the recently vacated 0.8 million square feet F2 building in the same park, which is also under refurbishment. We already have a healthy non-SEZ leasing pipeline for this block. For our partially SEZ buildings with around 3.5 million square feet of vacancy, we understand that a likely amendment to the SEZ Act is in advanced discussions at the relevant ministry level, and we continue to be hopeful for a resolution on this matter. Moving to our development portfolio. During the quarter, we received occupancy certificate for the 1 million square feet M3 Block A in Embassy Manyata. Coming months, we expect to deliver another 1.1 million square feet across 2 blocks in Embassy Business Hub and Embassy Oxygen, Bangalore and Noida respectively. Our current development pipeline now totals 7.1 million square feet. Of this, around 90% is in Bangalore, the city which continues to lead India's office absorption on the back of sustained interest from global capitals. Notably, around 25% of Bangalore development pipeline already pre-leased. There is a 1.2 million square feet advanced pipeline reminder. Lastly, on our hotels, our hotel occupancy stood at 52% and ADRs at over 10,000 rupees per room night, resulting in a quarterly EBITDA of 37 crore rupees. Overall, our hotels delivered a 24% year-over-year ADR growth, stronger than the market. Particularly, 3 Hilton hotels continue to grow strongly and deliver NOI margins close to 50%. Finally, we are delighted to launch REIT Association last month as a member. The association has already started work on key agenda items such as educating investors, improving liquidity, and collaborating with regulators on enhancing the REIT governance and investor protection norms. We're confident, together with the IRA, we will continue to build understanding and awareness of REIT products in India and further expand our unit holder register, which has already touched 89,000 this month. Let me now hand over to Abhishek for our financial updates.
Thank you, Arvind, and good evening, everyone. Let's take you through the financial updates for the quarter. Revenue from operations grew by 4% year-on-year to rupees 89 crores. This was mainly driven by our new lease-up at high releasing spreads, contracted rent escalations, ramp up in our hotel business, which was partially offset by the impact of exits in our portfolio. Net operating income grew year-on-year to rupees 719 crores, in line with the increase in our revenue. Net distributable cash flows grew by 1% year-on-year to rupees 524 crores. The year-on-year increase in our NOI contributed positively to our distributions, which was primarily offset by an increase in interest costs. So, we have declared Q distribution of 524 crores or 5.53 per unit, quarter of 100% distribution payout. Moving to updates on our balance sheet. During Q2, successfully raised non-convertible debentures and bank loans is 1,500 crores at an average 8.1% to refinance our maturing debt. For the new NCD raised, we achieved 121 basis points spread over GSEC and secured first-time participation pension funds for diversifying our investor base. We have reached 2,600 crores of upcoming debt maturity in Q4 of this financial year. We already have significant interest from multiple banks to refinance the entire upcoming maturity. We will also evaluate the debt capital market at the appropriate time during the next few months. Considering our diverse capital market pool and credit lines available from banks and NBFCs, we are confident of financing this debt at industry-leading rates. Next year onwards, our bond maturities are much more evenly spread out. Overall, the balance sheet remains strong with dual AAA ratings and in-place average debt cost of 7.4%, one of the lowest in the industry. Next on our investment valuation. As of September 20, our gross asset value increased year-on-year to rupees 5251 crores and a net asset value by 1% to rupees 398.86 per unit. This change was mainly driven by an increase in our hotel ADRs, partially offset by a change in the leasing assumptions for our Pune and Noida assets. Lastly, an update on our FY2023 guidance. Based on our YTD performance, I am pleased to reconfirm financial guidance provided last quarter. We continue to expect our NOI to be in the range of 2,924 rupees 316 crores and our distributions to be in the range of rupees 20.5 to rupees 22 per unit. This guidance is certain key assumptions, which includes revised 6.5 million square feet lease up, around 8% same-store occupancy by the year end, 6% year-on-year increase in the hotel EBITDA, and a 5 to 8% year-on-year increase in total interest expense for the year. Looking beyond FY24, I would like to reiterate growth levers of our business. First, we expect our occupancy to stabilize at pre-COVID levels of mid-90s in the next few years. Second, we will continue to lock the contracted rent escalations of around 15% every 3 years. Next, we expect to realize the current MTM potential of 12% over our remaining WALE of 6.9 years. We have consistently achieved these spreads in the past, around 20% on 2 million square feet area renewed or released per year on an average since our listing. On the back of our portfolio's premium positioning, our transaction rents have been higher than the market rents. Additionally, 7.1 million square feet of new supply that we are developing primarily in Bangalore offers over 20% NOI yield. Compared to current marginal borrowing cost ranging from 8 to 8.5%, this organic growth is expected to be highly accretive. Lastly, once the financing markets are conducive, any inorganic growth through accretive acquisitions will provide a further impetus to our distributions. These embedded growth levers sets us well to deliver consistent value growth to our unit holders next year onwards. With this, let's move to Q&A, please.
Thank you very much. We will now begin question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will also request participants to restrict questions to participants. If you have a follow-up question, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Al from Bank of America. Please go ahead. Al, you may go ahead with the question.
Sure. Thank you. Quarter on leasing. My first question is on the expiries, which seem to have gone up at 24. I'm adjusting for, the earlier renewal which has happened. I'm just curious as to which segment this uptake in expiries coming from, and is it typical that if demand or the leasing environment is improving, that the expiries should also be going up? That's my first question.
Sure, Kunal, you want to finish off the question?
Yes. My other question is around MTM potential, which noted has come down 12% over the last few quarters. The question here is that because you're very successful at renewing at market or market kind of rates, at the driver, or is it also because of the fact that market rates itself may no longer going up at the pace that they were doing earlier?
Sure. Thanks for the questions. Starting off with expiries for FY24, largely the increases are coming from the service players, the ITA service players. The exits predominantly after that sector. A combination of continued work from home as well as the profit pressures which you are seeing in that segment. So that's key reason for the increase in exits. From a leasing market perspective, Kunal, I think it's, as we've said in our results as well as what I spoke a little earlier, overall very positive, especially for the two key markets for us, Bangalore and Mumbai. Occupancy also has gone up. I mean, if you adjust for the Cognizant case which we did in our Manita Park, our occupancy has, Bangalore as a whole is also about 90%. Mumbai is at 96%. Record 2 million square feet, lease up 2.5 million square feet of pipeline as we speak. Overall RFP is also in the market much higher. So leasing market is much better. I think it's a transit period for us where occupancy is low, but we will see that going up, as you mentioned, even in our year-end guidance. So that's my view on the leasing market. And the last question, I think you kind of answered it yourself. It's largely because of the reasons. One, our ability to do renewals, releasing at or above market rates, number one. Number two, other than probably Bangalore and now a little bit in Mumbai, the market rents have not necessarily gone up to the same extent the way it used to go pre-COVID. A combination of both factors, you see the current MTM spread available at a much lower number than what it was before.
Understood. And just on quick follow-up, pipeline value of 2.5 million again is quite strong. Would you still characterize it as mainly coming from GCCs, or is the strength in that sense spreading to other segments as well?
Honest answer is largely GCCs. And it's just a little bit more flavor. It's a combination of large RFPs, which we've not seen in the past. Number two, it's also regular lease-ups for existing spaces. But I think one important number to highlight over here is almost 50% of these RFPs are new tenants for us looking at growth, and additional 40% of these RFPs are existing tenants but looking for more space. So when you look at it together, large part of the growth. So that's, I think, overall very positive.
Correct. All right. Thank you so much.
Thank you.
Thank you. The next question is from the line of Murtuza Arsiwala from Kotak Securities. Please go ahead.
Yeah. So I just wanted to check now, while the leasing activity has been good, obviously the exits have been bothersome. Even this quarter, you've had this 1.6. Some of it was anticipated. Some may have come in as a surprise. Any sort of, any trend that you can up in terms of the exit? Is it a particular client segment? Is it in terms of size, whether they're big tenants, small tenants, or any visibility going forward from here, whether, we're seeing the tail end of these exits, because you're to lease up pretty well. But with the exits, you're not able to sort of capitalize fully on the new leasing that we have. So any color that you can give on how should we think of the exits from here on? Is there more predictability? Any color that you can give on the exits?
Sure, Murtuza. Risks are bothersome to us also, even though we've been able to release much faster. But having said that, a clear trend is what I mentioned. A substantial majority of our exits are coming from the ITES sector. A combination of both reasons, profits or overall margins being down, their business model more amenable to work from home. That's, I would say, one which just stands out, which is added to the exits. So two things I would like to add on over here. Number one, ITES services in our portfolio is now at 12%. This number was 25% at the time of IPO. So there's already a substantial reduction in this portfolio size. So that's probably one indicator for you as to, what's the downside in this market. Not much. Second, overall, when you look at it from a FY20 point of view, I will not want to go beyond 25. There's about 1.1 million square feet of expiries, while I wouldn't want to specifically give a guidance. But I would say, as we speak now, the trends are more positive.
Sure. And even in the 24 for the second half, another million square feet, are you expecting to renew them? Would you be more confident to renew them?
I think it's going to be a combination of both, Murtuza. I would say it would be a combination of exits and renewals almost equal.
Okay, for your guidance for renewals about 1.2, you've been about 0.9 so far. Yeah, so fair enough. Thank you.
Thanks, Murtuza.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much. And sorry to live on the same point. If we see slide 16, it talks about 4.2 million square feet of expiries. Right? And the same number was 2.8 million just a quarter back. What really added to such? Am I not reading it correct?
Yeah, so one is this big early renewal, Puneet, with 0.6 million square feet of PM at FC Golf Links. That's reason number one, which is a positive. Second is almost 800 to 900,000 of additional expiries which have come in. And that, for the sake of repeating the answer, it's largely coming from the same ITES sector.
And what kind of discussions drive these early renewals?
Early renewals?
Yeah.
I think one of the things is considering this specific example, it's a large space. From their point of view, also they need to be sure of where they will be, let's say, 12, 15 months down the line. So it makes sense for them also to secure themselves whether they want to continue in the same space or if they want to explore a new space. They might really need more time, right, to move to a new space, set up a new office with fresh fit outs. So it's largely driven from the occupiers themselves because of the quantum of space which they already hold.
And in your data book is also 0.9 million square feet of leasing which happened in Manyata. I presume part of it would be the M3 block which was pre-leased. Can you give color on what is the average rental there? If you're able to derive now.
Yeah, average rentals I would say ranges between 96, 97 to a little above 100, depending on age of the buildings as well.
Understood. And also if you can give some color on what's the status of the M3 block, how much is it leased totally and how much more needs to go? And what did it finally cost the REIT?
Sorry, can you repeat the last question again? I didn't hear you.
And how much did it cost now entirely to build M3?
Got it. It's about 45% leased. On the cost, I'll just hand it over to Abhishek.
So the total cost was 1,050 crores, including the amount that we paid earlier and the additional true-up consideration based on the agreement that we had.
Okay. And 5% lease and presumably value at 86 to rupees.
Yeah, new blocks, I would say we've been able to exceed above 100 beneath.
Okay, that's very useful. And lastly, if I can add one more, there's a positive working capital adjustment this quarter. How long can we see these kinds of adjustments, and what is driving this?
Again, I would say that we don't look at working capital adjustment quarter on quarter. What we look at is for the year. Because quarter and quarter comes out of other regular factors also. Like for example, when you see current quarter versus previous quarter, the current quarter working capital coming out of the fact that during Q1 we had paid tax for half year. Tax of that is somewhere around 55 crores. So out of the 52 crores, main 55 crores is coming out of this.
Okay, so that was not there this time. But why should it get captured in working capital? Should it not be somewhere else in the P&L?
So what happens is if we pay this tax in advance, so it goes and sits in my advance payment, and during the next quarter when I do a working capital movement of all the payables, receivables and advances, so it's just there because it's reduced there. So if you look at just from cash perspective, last quarter 6 crores cash out, this quarter 0 cash out.
Understood. Got it. That's very helpful. And lastly, if you can comment on the distribution from the MSC Golf Links, that seems to also gone down a bit.
Yeah. So what happens is for MSC Golf Links, distribution that gives to us is purely based on cash flow that they have. Last quarter, the distribution that got into all three components was crores compared to 68 crores which we quarter. Also, what they do is some of this cash generate, they use for refurbishments and other projects also, and not necessarily through. That's the reason reduced a bit during this quarter.
Can you just add on to that, Puneet? I think from a Golf Links point of view, both we and the joint venture partner look at cash flows on a quarterly basis, look at what's required from a next quarter point of view, and there could be some movements on a quarter basis. It need not necessarily move linearly.
Okay. How often think about the way? Should we expect it to go up?
Sorry,
I'm sorry. I'm saying, how should one think about this number from next quarter or second half? Should it down or should it come back up to the previous levels?
What happens is out of the three components, one is interest, is fixed based on coupon rate. Okay. The other two components is based on the availability of cash. I would say that the way to look at it is if whatever we received during the first quarter and second quarter, whatever we received in the half year, you can say double of that you would receive in the year.
Understood. That's very helpful. Thank you so much.
Say per quarter on an average run rate basis.
Understood. That's helpful. Thank you so much.
Thank you.
The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. Arvind, in your opening remarks, you mentioned that, by the end of the year, you expect the occupancy to stabilize around 85%, 88% on same store. Now, that number is nearly similar to where you started the year at. So I understand there's some capacity issues. In that context, how do you see distribution or the NOI in FY25? I understand you're not giving a guide. You give some color as to what kind of growth impact in you and the occupancy seems to be flattish. Throw some light on that.
I think a simple answer for that, Mohit, was captured in Abhishek's last line, which is we clearly said that we expect the DPU to grow from next year. So I wouldn't attribute a number to it, but we clearly believe that NOI and DPU will grow from next year, from where we will end this year.
Okay, understand that. Second question is, and for Abhishek, I was just trying to do some math in terms of is on a year-on-year basis gone up 7 to 8%, which is great. And the area under lease has also marginally gone up, but the rentals or the NOI is flattish. So, can you throw some light on why that is?
So, Mohit, when we close the in rentals, it also includes the in-place rentals of all the portfolio, which includes GLSP also. If you strip that out, then I think in line with the increase in the NOI we have.
Okay. I felt that offline and understand that from you. And my last question is on the the share of interest in the distribution that you've announced this quarter has gone up sharply from about 12-13% to 22%, which will impact tax distribution. So how do you see that going forward? Is it like this one or going to be the new normal?
So Mohit, actually, if it's last quarter, it was somewhere around 15-16%. It has moved to 20%. The reason for this is two reasons: because depreciation is going, is increasing, and because of which the profit margin that we have is decreasing and the dividend distributability is decreasing. I would suggest that if you say that whatever was there for the half year, which is around 17 to 20%, that will continue for the rest half year also.
Okay. And just a last question, if I may, Arvind, on the SEC notification, you mentioned that this is, anytime due. So once it comes, you have to, between the regulations and approvals and the tax impact which will be there, how much time do you think will take for it to actually start reflecting the positive impact?
Honest answer, $1 million question, Mohit. Honest answer, I think we just need to wait for final regulations. In my view, it will take some time for the operational mechanics to stabilize, because this will also require some approvals. What level of approvals? Because whether it will go to a unit approval committee, whether it will go to a board of approvals of SEZ, some of these we will have better clarity once the regulation comes. And I think I will wait to give a specific answer on this for the final regulations to be out, and we have some visibility of how long it takes to actually de-notify flow by flow.
Okay, thanks a lot. That's all.
Sorry, last message I would give is, again from a perspective, Bangalore will rebound much faster even on the SEZ converted space as compared to our Pune and Noida portfolio.
Because the approval faster.
Not really, just micro market related matters.
Okay, thanks a lot.
Thank you. The next question is from the line of Chetan from Concall. Please go ahead.
Hi. Three questions from our side. Firstly, on the true-up amount which is paid, so the book mentions about a figure of about 30 crores. So I just want to understand whether that represents a cash payment from the REIT to Embassy, and where do we tie it up with the financials? So that was question one. Number two, we wanted to understand some color on the physical occupancy which you're seeing now in your parks and any trends which you can highlight for us city-wise. And number three, on Golflink's renewal for the major client which you have done, what could you elaborate on any kind of tenant improvement costs which could have gone there, or and whether, if you can directionally give us a sense on the rent bills, whether it is, I think you mentioned about spread, but does it factoring any other entry periods or any of such discounts which could have given potentially to such a large client?
Thanks, Chetan. I'll just ask Abhishek to answer the true-up part, then I'll take the rest of the two.
Chetan, when we mentioned that the total true-up is 30 crores, as at 30th December, we had paid only 8 crores. The balance 148 crores was paid post September 30. That is the reason why you may be having trouble in reconciling directly from the financials, because say the Q3 total 230 will reflect in the financials.
Okay. Would represent a clear outflow of cash from REIT embassy entity.
Absolutely.
Yeah. Okay.
As at 30th September, we had paid only 80 crores.
Okay.
This is moving to physical occupancy. I think I would say more or less things are kind of stabilizing where we are today. From a directional sense, taking city by city, Mumbai is more or less stabilized at full occupancy. Bangalore, I would say it's a mix. Like we've said before, those are at a much higher number. It ranges from 65 to 75%. And you could argue that 75% is capacity, because probably even before it was never 100%. Right? So you could capture almost back to, in a way, full capacity. Versus ITITS is still low at 35%. And that's primarily the reason why you're seeing exits in that sector. Right? So that's a sense of physical occupancy. In relation to EGL renewal, couple points. One, of course, we just need to do some refurbishments and upgrades to the building before they get up, and we have 1 year time to do that. In terms of still, without giving any specific number, all I can say is that we are very close to the market rate at which we have leased. So overall, I would say it's a very good outcome for us.
Understood. Thank you so much for this.
Thank you. The next question is from the line of Gaurav from JP Morgan. Please go ahead.
Yeah, hi. Just two questions. So one is in terms of interest expense. So what is your incremental interest cost versus the current cost you're seeing? So I just know the differential now left to reprice up. The second is this movement of the available space that you're seeing. So when do you think this piece turns more positive? So currently your new leases are equivalent to the expiries and the area vacated. At what point do you think start draw down on this vacant space? Should it be next quarter or next year? How would you think about it? Thank you.
So why don't I take the space question first, and I'll give it to Abhishek. Saurabh, on a net basis, honestly, we believe from next quarter onwards it should be positive. When you look at it holistically, while we've said that we'll be at 85% portfolio occupancy, factors in the 2.1 million of delivery. So the short answer, yes, it is going to be positive from next quarter. But when you look at it for the full portfolio, including new deliveries, it will go up from next year onwards.
Okay. Ex new deliveries, you should see this now going on next year onwards, right?
Yes. Okay. That's correct. That's correct. Over to Abhishek on the interest.
Sort of on the interest part, last NCD that we did was at around 8.1%. From there, the interest cost has slightly moved up. With increment cost would be in the zip code of 8.5% one rate. If you look at from the year basis, then as per our guidance, we had guided that the interest cost would be around 15 to 18% higher than what it was during the last year.
No, that I understand, but I just want to understand. So 8.5 is your incremental cost, and your reprices over. How much of this reprices in next year?
Next year, sir?
Yeah, fiscal 25.
But just give us a second. We'll just pull up the number. Yeah, it's around 2,400 crores.
Okay. All right. Got it. Thank you.
Thank you.
Thank you. Next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hey, hi. Thanks for taking my question. So just a couple of them. Firstly, on capital structure side, we are now around 29% leverage, and we are looking to move 33%. So I think we pause at 33, or you still think we will go all the way to like 40 odd?
Sure, Abhinav. You have any further questions?
Yeah, second one is actually on the supply bit, and this broader market question. So are we seeing any let up supply in your core Bangalore market, or it's still continuing at the same pace that we had previously, despite the higher vacancies in the overall market? That's those two questions.
Sure. I think in terms of leverage, the way, I don't know how you computed 29 going to 33, but the sense is, I'm presuming that you've taken all the capex be spent on new build, increasing the loan balance, but that also increases the gross asset value also. So it does not increase in that proportion. So I don't see that number going up to the percentage what you mentioned, first number itself, forget about 40%. Anyway, we have a hard cap of 35, which we can never cross. So my sense is we'll be below 30%. So that's the answer on debt. In terms of supply, just focusing, while there is a lot of supply coming up, from our point of view, I would just focus on Bangalore supply, because 7 million square feet of our development is in Bangalore. Bangalore, even if you look at the upcoming supply, it's for the next 3 years, it's in the same zip code as what it was in the past, approximately 15 million square feet per annum. And if you go line by line on the expected supplies over the next 3 years and compare it to the supply which we have, which is largely in Embassy TechVillage and Embassy Manyata, I think I don't necessarily we can compare some of the supply to the quality we have because of the ecosystem which we've already built in TechVillage and Manyata. So somewhere we always get the upper hand when we are competing with some of the developers for space. Not that we win everything, but we win a majority. I wouldn't be concerned on the overall supply coming up in Bangalore.
Okay. See, on the gearing, if I may, further ask that question. So, see, there, appears the headroom that we have to raise gearing further is, much limited than what it was 3 or 4 years back. So, will you, when the DPU starts growing from next year onwards, in a reasonable way, will we be like capping out, paying out the whole 100%, or we will like down a little bit to reduce that thing?
Yeah, hey, it's Ritik. Abhinav, let me take. I think we view sort of gearing as a very sort of charged question in a situation, right? I mean, if you just look at sort of what's happened in the markets over the last 3 or 4 years, I think we've done a phenomenal job ensuring that the balance sheet remains as pristine as possible for a couple of reasons. One is, look, our capital market tends to be very shallow. We just don't have the firepower that, REITs, let's say in Singapore or the US have. So, we've always been very focused on making sure that we're very selective about the projects we take on. Right now, it's just it makes more sense for us to build and finance at, the rates we have because it's more accretive in-house than go out there and buy something that potentially we can't make the numbers work, right? So at the end of the day, that's effectively how we look at gearing. Now, if there was, and that's why we also took the entire decision of capping at 35%, because leverage has always been a bit of a situation for real estate in this country, and we've been able to sort of use it selectively to build out the parks internally, buy world-class assets like ETV, and make sure that we can sort of build the portfolio that we have. So look, I mean, bringing out as we've said, distribution grow in the cycle. This I think represents the last of sort of the stagnant kind of situation that we've seen. But as it grows, I don't think there's any plan at this point in time to sort of cap payouts, right? I think that's not sort of the correlation we see. We'll take on debt, selectively to fund growth, right? The organic growth, I think we lay out very simply. It's within the park and it's accretive. The inorganic growth right now, we just don't see that in front of us. Simply, it's not, and it's probably going to be a little expensive and to sort of together at the point. So I don't. The question really for us is we don't have any plans of actually capital distributions pay out as they grow. We want to make sure that unit holders get full value for what they bought into the structure for. And I think as the leasing comes on, as it increases, we plan to sort of pay that out right now.
Excellent. Thanks. That's very helpful. That answers my question.
Thank you. The next question is from the line of Satinder Singh B from Eon Infotech Limited. Please go ahead.
Yeah, thanks for the opportunity and congratulations on very stable distributions, good leasing performance and outlook, very efficient funding, execution of development which is on track, and your usual disclosures. Okay. My questions are the following. So, Arvind gave a flavor of the physical occupancy for Bangalore and Mumbai. So can you throw some light on the two markets also in terms of whether there's a movement, physical occupancy over the last 3 months, or is it kind of now stagnating or stabilizing at the level earlier? And in terms of the scope of space by new clients, past mentioned that decision-making cycle, especially for larger spaces, has been extended. So are we seeing that coming down? Because we guided for commitments of about 20 million square feet. It seems that on that one parameter we got some catching to do. Okay, so are these related? So is the decision-making cycle coming down, or is it still kind of still elongated? And the rentals outlook. So how have you seen rental outlook move in the markets that we operate in? Yeah.
Got it, Satinder. So just taking the physical occupancy, I kind of addressed that by sector instead of city in a way by saying that it was kind of stabilized between 65 to 75. Services continue to stagnate 30 to 35. Noida and Pune for us is a hardcore IT services market. So it's at range around 35%, not really moving beyond that. So that's on physical occupancy. In relation to the leasing cycle, I would say the decision-making cycle, it's a mixed bag. There are few leases which are moving much faster than what it was before. There are a few which takes elongated time. Overall, when you look at it from a guidance point of view, yeah, I mean, commitments very difficult to say that it will flow evenly across the 4 quarters. It can be very lumpy. It could all come in 1 quarter, 2 quarters. But overall, I would say things are being much better. Few deals take similar amount of time, 3 to 6 months. Some happen much faster. So that's a sense on decision-making cycle. In terms of rental outlook, I think clearly in Bangalore and Mumbai, we are seeing rents going up, ranging between 3 to 5%. Generally, we've been able to lease at much above market rent. You would have seen it by the numbers which I mentioned for Manyata time back as compared to what the IPCs call as market rent, which is around $94. So these two cities definitely have gone up in our portfolio. Versus say Noida and Pune, the rentals have remained stagnant for some time and continue to do so even now. So that's the sense on the rental outlook.
Okay, that's very helpful. Finally, one housekeeping. Okay, talk of renewal at 56% reversion. So is this the current rent, the cash rent over cash rent, or is it the equalized rent over equalized rent? Okay, so
it's a cash over cash, Satinder.
Cash over cash. Yeah, thank you, and congratulations. Great show.
Thank you very much.
Thank you very much. It was the last question in queue. There are no further questions. On behalf of Embassy REIT, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.